Welcome to the only technical analysis video you will ever need. Whether you're brand new to trading or you've been in the markets for a while but haven't found consistency, this video is your one-stop guide to mastering the technical side of trading. By the end of this video, you'll understand how to read price action, use indicators the right way, identify trends, spot reversals, manage your risk, and build a repeatable trading system. Let's dive in. Let's start with the basics. What is technical analysis? Simply put, technical analysis is the study of price movements using charts. It assumes that all known information is already reflected in the price. So rather than analyzing news or economic reports, we focus on patterns, price behavior, and data on the chart. Every indicator, strategy, and concept in technical analysis boils down to one core thing: price. Now, before we get into tools and strategies, you must understand candlestick charts. A candlestick represents a specific period of time and shows 4 data points: the open, high, low, and close. The body shows the open and close, while the wicks, or shadows, show the high and low. A green candle means the price closed higher than it opened. A red candle means the price closed lower. This gives us a visual sense of market sentiment in a way that line charts cannot. Single candles can tell powerful stories. A doji candle, where the open and close are very close, signals indecision. A hammer shows that buyers stepped in after a sharp move down. A shooting star is the opposite, it can indicate a reversal after a rally. But more powerful than single candles are candlestick patterns, 2 or 3 candles that form reliable signals, such as engulfing patterns, morning stars, evening stars, and pin bars. These patterns become more effective when they form at key support or resistance levels. Speaking of which, let's talk about support and resistance, the foundation of price action trading. Support is a level where price tends to stop falling and bounce back up. Resistance is where price tends to stop rising and reverse downward. These levels form due to previous buying and selling interest, and they are psychological zones where traders take action. Price doesn't move randomly, it often reacts to these levels repeatedly. Learning how to identify horizontal zones of support and resistance is one of the most important skills in technical analysis. Now let's move into trend structure. Markets don't move in straight lines. They move in waves, impulse and correction. An uptrend is defined by higher highs and higher lows. A downtrend is defined by lower highs and lower lows. A range-bound market moves sideways between support and resistance levels. Your first task in any analysis is to determine whether the market is trending or ranging. This will influence what strategy you use. For example, in a trending market, you might look to trade pullbacks. In a ranging market, you might focus on reversals at support and resistance. To help identify trends, many traders use moving averages. A moving average smooths price over a certain period, helping you identify the general direction. A 20-period EMA, exponential moving average, is commonly used for short-term trends, while the 50 or 200 EMA is used for long-term. When the price is above the moving average, and the moving average is sloping up, that's typically a bullish sign. When price is below and the average is sloping down, that's bearish. Crossovers, where a faster moving average crosses above or below a slower one, can signal changes in trend direction. But indicators are only as useful as your understanding of them. Indicators are tools, not signals. They are best used for confirmation. For example, the Relative Strength Index, RSI, is used to measure momentum. It oscillates between 0 and 100. Traditionally, RSI above 70 is considered overbought, and below 30 is oversold. But in strong trends, RSI can stay overbought or oversold for a long time. That's why it's best to use RSI in combination with price action, such as divergence between price and RSI or confirmation of reversal candles. Another useful indicator is the MACD, Moving Average Convergence Divergence. It consists of 2 lines that track momentum and trend strength, along with a histogram. When the MACD line crosses above the signal line, it's a potential buy. When it crosses below, it could be a sell. But again, context matters. You don't want to take MACD signals blindly, use them alongside structure and trend confirmation. Now, let's talk about chart patterns. These are visual formations that often precede specific movements. Common continuation patterns include flags, pennants, and triangles. These suggest the trend is likely to continue after a pause. Reversal patterns include double tops, double bottoms, head and shoulders, and wedges. These can signal a potential change in direction. For example, a double bottom forms when price tests a support level twice and fails to break below. It often signals a shift from bearish to bullish sentiment. One tool that combines perfectly with price action is the Fibonacci retracement tool. This is based on the Fibonacci sequence and is used to identify potential pullback levels in a trend. The key levels are 38.2%, 50%, and 61.8%. In an uptrend, you might wait for price to pull back to the 61.8% level before looking for a bullish signal. When this pullback lines up with previous support or a moving average, that's called confluence, and that makes the level more significant. Understanding entries is only half the battle. The other half is risk management. No matter how good your strategy is, if your risk is out of control, you won't last. Before you enter any trade, know your stop loss, your target, and your position size. Your stop loss should be placed at a logical technical level, such as below a swing low in an uptrend. Your target can be based on the next resistance level or a fixed risk-reward ratio, such as 1:2 or 1:3. This means you're risking 1 unit to make 2 or 3 units. Never risk more than 1 to 2% of your total account on a single trade. This protects you from emotional decision-making and long-term damage. Position sizing is what ties your technical setup to your account balance. For example, if your stop loss is 50 pips and you want to risk $100, you calculate the appropriate lot size to match that risk. This keeps your trading consistent and prevents large drawdowns. Another essential component is trade management. Do you take partial profits? Do you trail your stop loss? Do you exit early if the setup changes? These are all important questions. Some traders prefer to scale out of trades, taking partial profits at 1:1 and letting the rest run. Others use trailing stops, where the stop moves up as the trade moves in their favor, locking in profits. Whatever method you choose, it should be defined in your plan. Speaking of plans, every trader should have a trading plan, a clear rule-based guide that tells you what to trade, when to trade, how much to risk, and what criteria to use for entry and exit. A plan removes guesswork and emotion. Without one, you're gambling. Let's do a quick example to put it all together. Imagine you're looking at a forex chart. The pair is in a clear uptrend, price is making higher highs and higher lows. Price pulls back to a previous support level, which also aligns with the 50 EMA and the 61.8% Fibonacci retracement. At that level, a bullish engulfing candlestick forms.